Hey everybody, Tom Gentile. Welcome to Tom's Trading Room. It is Thursday, April the 2nd, 2020. And as you can see behind me here, I am rolling heavy with education, information, and of course, maybe even a trade or two. Make sure you click on the subscribe button at the end of this video if you want to get all these videos on time. I'll be doing one every market day for the month of April. So glad to have you here. Let's talk about, we're going to talk about the markets real quick. I want to talk about trading volatility using horizontal time spreads. For those of you that are option traders out there, you're going to love to see this. And we're actually going to look at a case study in USO. So let's go ahead and get right to it. Today we had jobless claim numbers come out, 6.6 million. This is record setting. We've never had jobless claims like this before. Tomorrow, we've got the big jobs report. We'll get to that in a moment. Markets went, basically they were up overnight. Then they came racing down flat. Now they're back again. Volatility is definitely here to stay. If you think the volatility for today is big, wait till you see what's coming tomorrow. Because tomorrow we've got jobless claims. Now, question I had yesterday, how do you look at the markets overnight? If you don't have software or a brokerage platform that allows you to look at overnight trading, you can do so by going to www.cmegroup.com and you can get the information there. Scroll about halfway down the page and you'll see what I have on the screen here. And you're looking at equities, energies, even agricultures, and then right here, the E-mini S&P 500 futures contract. This is the one that I look at when the markets are closed. And I can get an idea on where they're going to open tomorrow based on that number right there. All right, also the overnight markets. Here's the jobless claims. This is where the S&P was, just shy of 2,500, and it dropped all the way down to 2,447. This was before the stock market even opened. So if you are a Thinkorswim user, for instance, you want to look at the symbol, and the symbol I'm using is /ES. That is the E-mini S&P 500 futures contract tracked right there in Thinkorswim. All right, this is another example, and right here you can see all the volume that came in with the jobs report pushing that down. We've since then gone much higher. Now, yesterday I saw this popping up, and I wanted to share this with you before we get into today's subject. S&P 500 over here on my my right, my left, my right, your left. Zoom on the other side. The S&P was moving down yesterday, and this was between 11 and 12 o'clock. All right, it was down on the day. Interestingly enough, Zoom, which I'm used to seeing going up when the markets go down and down when the markets go up, did an about face yesterday as it was trading around $145 a share. It dropped immediately, did a little bit of a rebound, but then started trading lower. And it made me think, is the correlation, are we finally too far overbought with Zoom? So I ended up doing call spreads in my own portfolio, and those are actually turning out pretty good as Zoom continues to zoom downwards. All right? So the other thing I want to mention is Luckin Coffee. All right, Luckin Coffee was supposed to be this big chain that was going to jump all over Dunkin' Donuts and Starbucks. And of course, today we find out, again, before the markets even opened, trading in the pre-market from about 8:30 to about 8:45. This stock went from $27 a share down to $3.74. Incredible. What can make a stock drop like that? Let me tell you what can make a stock drop like that. Fraud can make that go down. All right? Falsifying your earnings statements and other financial statements, that can make that go down too. I'll be surprised if this one's even trading next month. Okay? And then finally, the oil squeeze, and this is what we're going to talk about today. So the USO and oil in general jumped on that Saudi-Russia saying they're going to cut production. We went from 467 on USO, and within 10 minutes, we were trading at 567. That's a full point up. This was actually up over 20% at one time. In fact, actual crude oil itself was up over 30% at the time. So I don't think this is going to last, okay? Because we saw a lot of folks rushing in. In fact, I sold USO at around 555, okay? But that's not all I'm going to do. I want to create a position that makes sense if USO goes back down to around the 450 level, which was the low this morning. In fact, I'm not going to give it a day or a couple days. I'm going to give it a few weeks for that to pan out. I'm going to show you how I do that with our new discussion on volatility. So before I begin, remember, it's April 2nd. Watch for a continuation of volatility. This week, volatility might spike with tomorrow's jobs report. That's the biggest report of the month. So if you think today was crazy, come back again tomorrow and see what ends up happening. And I still expect pullbacks to continue back down to those 2016 levels. And so maybe the jobs report, because we got a little bit of a bump up today, but maybe that jobs report sours the market once again. Let's talk volatility. So in rules-based trading, I look at being a short-term trader and a long-term investor. We're going to go back to short-term trading right now with a 2-week trade in USO. What I'm looking at doing is I'm not going to be fundamental. I'm not going to be a news trader. I'm not going to just buy calls if I'm bullish or buy puts if I'm bearish. I want to be a volatility trader. There are 3 ways to do that. Yesterday we talked about volatility by history. Today we're going to talk about volatility by expiration. So this is volatility by time. This could be any chart, but it's Ecolab. And if you noticed, as of this particular chart, Ecolab's 7 to 30-day options had a volatility of 80. All right? The 30 to 60-day options had a volatility of around 63. And the ones that were 90 days or greater, 54. Do you see a pattern here? All right? The short terms have higher volatility, the long terms have lower, and quite a bit. So if I could sell this high volatility here, sell, and I could buy the low volatility, I could create a spread on this volatility. In order to do that, I have to sell the short-term options and I have to buy the longer-term options and create a volatility hedge by time. Okay? So this is how we do this. We do this buying the longer-term options, selling the shorter-term options with a calendar spread. All right? A calendar spread allows us to do just that. Let me show you a real-time example with USO. So in order to do that, I'm going to pop back over to my computer. And I'm going to go to tomsoptiontools.com. And what I'm going to do is, here's a chart of oil. And again, oil had, let me pivot real quick. Oil had the pop today. Moved a little bit higher for USO. Let's pop on over to look at some options on USO. And what I did was I created a calendar spread. And what I'm doing is I'm looking at buying the May 15th 4.5 puts and selling the April 17th 4.5 puts. Same strike, buying May, selling April. All right, I'm doing that for a cost of, I'm trying to do it for a cost of 25 cents. So here's the big thing I want to show you here. All right, I'm buying the low volatility, 139, and I'm selling the high volatility, 168. So you can see there's almost a 30-point difference between these two volatilities. So definitely greater than, we're somewhere in that 15-20% range in terms of the high vol to the low vol, which is fantastic. The other thing I want to look at is I want to look at the risk graph of this particular trade. And I'm going to pivot again. Once again, I'm going to move over so you can see the risk graph. This is the risk graph. This looks very familiar. It looks very familiar to a butterfly graph, but it involves 2 options instead of 3 different strikes. Again, I'm long the May, I'm short the April, and if we come down to 4.5 within the next 2 weeks, that's the sweet spot on this trade. All right, I'm looking at a trade that's going to cost me roughly $2,500 to do 100 contracts, but I'm looking at potentially a $4,000 plus return based on volatility in USO in the next 2 weeks. So how do I place that trade? Very simple. All right, here we go once again. I am selling to open the April 4.5 puts, buying to open the May 15th 4.5 puts. I'm trying to do that once again for a 25-cent debit. This is a debit. It cost me money. And we'll see if this ends up getting filled, guys. So once again, I want to thank you for joining me on this update for April 2nd, 2020. Once again, feel free to hit the subscribe button so you get these on a timely basis. And if you want access to the tools that I'm using, I'll provide a link at the bottom of the video. Have a great day. We'll see you tomorrow. Bye now.